Rich Moskowitz, Mike Rosenbaum. Who else was here for breakfast? Marty Raffner, Mike Forrest, Bob Greenberg. You? Larry? Key? Ned? Ed Silver? Thank you all very much. My belly thanks you. The other members thank you. We appreciate it. We were chatting prior to the start of this meeting about how many organizations we've been members of over the years. And what happens with organizations is that the president does a lot of work and he gets burned out and then tends to drop away from the organization that he or she, if another organization, has worked so hard for. I look around today, and in the 20 years this group has been in existence, there have been 5 presidents. And they're all in this room today. Mike Perloff, Bob Greenberg, Larry Nadelson, Rich Moskowitz, Dave Wynn, me, and now our future president is in the room. All right, our president-elect, as we call him, Don Weisenstein, will be our new president.
You still have to vote for him, though.
We have to vote for him. It's him or the president's cliff.
All in favor? They wanted somebody younger, so.
Well, we must be old.
Anyway,
Screwed that up.
We'll make you old.
I'm looking for somebody. I don't see him, so I'll hold off in another announcement. Where is he?
Who is he? Who is he?
Bill.
Bill.
Bill Roth.
I saw him walking down.
Okay. I'll wait till he comes. There he is. I want to welcome back Mike Forrest and Bill Roth, who have both been out. Mike is in Florida, but he flew up just for this meeting. He desperately wanted to learn about insurance.
I thought he wanted to bang on.
And Bill Roth's been out with an illness, and we're glad to see Bill back again. I see a couple of guests in the room. All right, we met Larry, who did the Motzi, Larry Hadoff, and I see another strange face. You are?
Eric Yulesman.
Eric?
Ask Dave Wynn, he knows me.
Oh, you do know somebody here. You didn't just drift in because you want free food?
There's a lot of guys.
Welcome, Eric. You pay your dues, you're a member. Well, then stand up. We need you, yeah.
This guy right here.
This gentleman played softball for sex.
He plays softball.
He used to.
Well, take 1 minute and tell us about yourself, where everybody could hear.
That's a pretty general question.
Well, what do you do for a living?
I got a 6-year-old boy, he's in first grade. Married a beautiful woman from Long Island. I have my own business. I do commercial window treatments.
Do commercial what?
Window treatments.
Commercial window treatments.
I work for this,
Oh,
built this place.
my wife's in love with you.
Chuck Black, you know Chuck Blackman?
Yeah.
You know him? Yeah. I do a lot of work for him. I did the Boyd's Cardio Center and Lockheed Martin. I did the window treatments for those.
Really?
Yeah.
In Moorestown?
Yeah, how'd you know that? I worked there, probably. Warren Highway.
No, I work for Morgan Stanley, but I have a lot of clients in that building. That's all.
Well, just opened up the cardio center.
Okay.
You said
All right. Okay.
What else you want to know?
No, that's it. Thank you very much. Just, all right.
Basketball during the week with Carl and those guys pick up, and this character tries to sell me electricity every week. What else you want to know?
That's it. I'm sorry I asked. He drives a green Mini Cooper, he said.
Yeah, I do.
Ed Stein, tell us about, first of all, a couple of weeks ago, we did go to that Broadway play in Philadelphia. So there's a Philadelphia play about the stoop on Orchard Street. And I had a great time. Beautiful facility, that the Jewish Museum in Philadelphia. If you haven't been there, you ought to grab an opportunity to attend. Anyway, Ed organized that. It was sold out, and we appreciate it. And now Ed's got another idea for us. So,
I'll just take a second just to get any interest. Cirque du Soleil is coming to Camden in May with a new show called Totem. There are group tickets available. The tickets run, the normal prices run 60 to like 100. The group tickets, depending on the size of the group, can be anywhere from $10 to $20 off. I just wanted to get an idea if people were interested or not. I haven't really put anything together on it, but I think if we had 20 people, it's $20 off a ticket. And of course, we'd have to pick a night. It's there for, I think, about 30 days, starting early in May.
Where at?
It's going to be next to the E-Center, the way I understand it. They set up their own tent when they come. They have this huge tent that they set up. Interest, anybody, just give me an indication if you might be interested. I mean, it's their shows are just great
2,
if you haven't been
4,
there.
6, 7, 8, 9. Wow.
All right, seems
Okay.
like we have some interest. All right, let me see if I can come up with something, and we'll send out an email.
If any of you have never seen Cirque du Soleil, there is a 3D film over at the Ritz, which I urge you to take a look at because it gives you 3 elements of different shows that are running around in the country, mostly in Las Vegas. And it's just a phenomenal experience if you've never seen Cirque du Soleil. Also, if you've never been to the Jewish Museum, it is a place you need to go to, and they are having serious financial difficulties. So anybody who will walk in will be helping them. So please consider those 2 items.
Thank you. I walk next to Len, not because I want to get my ugly punim in front of the camera. It's because I'm wearing the mic.
Oh, okay.
Okay?
You can Photoshop them out, can't you?
While I am losing your attention, I want to mention that in January, our meeting here will start a half hour earlier. The January meeting coincides with Super Sunday here at the JCC. And this room, as well as every other room in the building, is turned over to Super Sunday events and telephone calls. So rather than not have a meeting, we will still have our meeting, and the subject is the Holocaust Museum downstairs, and we will have a tour of the museum downstairs. It might be a little truncated in its time, but we're still going to have our tour of the museum, and then we are going to go, and those of us who want to stay and participate in the telephone calling for Super Sunday, all right, we'll just transition right into that.
What's the date of the meeting?
Okay, it's January 27th or something like that.
27.
27th? Okay, January 27th. Which segues into the agreement that the South Jersey Men's Club is signing with the JCC for another year here in this room. We we came here for a one-year trial, and they have picked up our option, and we're here for another year. And we're glad to have it. We are still working with people of the JCC Men's Club, and exchanging attendance between the two groups, and it's working out nicely. So I'm glad to say we will be here for a year, and if anybody has any ideas how to make it better, feel free to speak to anybody on our board. Any questions about that?
I have a question.
Yes.
When we first got here, we were told that if enough people join, we would not have to pay rent on the room.
Right.
What's the status of that?
The deal was that we are paying $100 per meeting to be here, not to exceed $1,000 in a year. If we would double our participation rate as membership into the JCC, they would then discontinue charging us this $100 per meeting fee. All right? I haven't really checked to see how many people have joined over the last year. We needed quite a lot. We needed like another 27. We had 27, we needed 54 members of our organization to also join the JCC, and my sense is we did not get that. So we're still paying the $100, all right, per person. How many people, well, this isn't all our membership, but this is, a nice size, about half our membership. How many have joined from here in the last year? 1, 2, 3, 4, 5, 6. You're a member now, but join for the first time. Okay. All right. 3, 4, 5. All right. I could ask them to run that again to see if we could save that money. All right. Good question, Len. Thank you. Anything else? Are you practicing for your for first pitch? Pitchers and catchers do report in. Okay. Clearwater. You got anything? Ed Silver. And come near me so you can get the mic.
Okay, I was looking for this picture, that, and this. Okay, as you know, I am representing actually two boards. One is the JCRC, and now I'm also in the Federation's board, which deals with their fundraising. And I sent around an email, Randy sent out an email. There are going to be two programs that the JCRC is sponsoring. One is about the Israel elections. It's on your email, but I'll send it around again. Another is on the Israel Advocacy Program. They're doing a 3-part series, mostly focusing on educating high school and college students on how to deal with issues about Israel, especially as they contend with organized right-wing groups that are pro-Arab and pro-Palestinians. So these programs might be of interest to you and your family members. With regard to the Federation, each table has a little, just to give you an idea with some of the things that the Federation is doing through the Jewish Family Service. So you might want to look at that. Also, with regard to the Super Sunday, I don't know how many of you as business people would like to sponsor a phone. If you've ever done the phone calls, when you're sitting at the phone, there's a plaque or a sign indicating that the phone was actually sponsored by some organization or family. And there's a price. It's all listed here. There's one at every table. I'm also thinking that maybe the board ought to consider the men's club sponsoring a phone next year. I'll leave it up to the board as to whether they want to do that. So that's all I have to say. Thank you.
The Israel Advocacy program called 3-part Israel Advocacy, say that 3 times fast, training program for teens. This was a series that was put on last year, and they're doing it again, and it is well worth seeing. The first one of the series, it's actually a series of 4. There's 2, 3, and 4. The first one was the video called Intifada on the Campus that we saw right here. And the same group has done 3 more, and they're putting it on around the, they're putting on 3 Mondays, February 11th, 25th, and March 10th here at the JCC. It is very, very well worth seeing. I tried to get these DVDs for us to look at them, and I couldn't get a hold of them. And I'm glad they're putting it on again. So if you are available, pay attention to this. We did get emails on that. If you haven't deleted those emails, it's well worth attending any one of them. They're all discrete to themselves. So if you miss one, it doesn't mean you can't go to another one.
I forgot one other. Unrelated to my activities with different boards, we started a book exchange, and there are a few books over here that people have brought in. You're welcome to bring books next time. Take what you want, bring those that you don't want, and anything left over we donate to the JCC. So it's another way that we can improve our relationship with the JCC.
Okay. Are you gonna? No. Okay. You're not gonna introduce the speaker, so I will. Our speaker today, all right, is this guy that we've barely seen around here. All right. Thank God he's here at every meeting. 4-year past president of the South Jersey Men's Club and an insurance expert. And you're talking on insurance.
Yes, something I know a little bit about.
Bob Greenberg.
Anyway, first of all, a lot of you guys know me, but let me give you a little bit of my background so that you understand a little bit here. First of all, I've been in the insurance industry for over 43 years. That means I started when I was -4. Okay. I don't know whether it's through my experience or just because, but I'm considered a subject matter expert, both nationally and internationally, on several topics. First of all, coverages, policy construction, specialized contracts called reinsurance agreements, and complex claims. And I have been involved in a lot of the stuff that you read about, but you never really get all the full story about insurance. I'm going to talk a little bit about homeowners insurance. I'm also, at the end, I'm also going to cover a little bit about Sandy, because last month when we were meeting, a lot of people were talking about it. It was a big, big subject. And there's just a lot of things, not a lot of things, but there are enough things that people really were having a hard time grasping. That's where this insurance, do we really need it, came from, because somebody said, well, with all of the federal money that's being thrown around, does people really need insurance? Well, I'll let you judge for yourself once we get done covering the topic that I wanted to cover today, which is basically homeowners insurance. This came out of, you guys remember the hailstorm that we had 2 years ago? And there were a number of people who were submitting claims to their insurance company, and there were a lot of stuff going on, and there were people running around telling you, don't worry about it, you'll get your free roof, it's not going to cost you anything. And I said, that's not necessarily true. So, let's talk a little bit about homeowners. First of all, what I'm going to try to cover is basically what coverage it provides, how much coverage do you really need, and how is your policy priced? You get a bill. What are you paying for? How did it come up with that? And for some people, they got a shock with their bill, and the question is why? So let's talk first of all about standards. When people come to me and they ask a question about the fact that they've had a loss, first thing I ask them is, well, what kind of a homeowner's policy do you have? 99% of the time they say, I got a standard homeowner's policy. Well, is there a standard homeowner's policy? Well, the first question is there a standard home? You can have a home like that, or like that, or like that. And each one of these homes may be covered by a homeowner's policy, but they're not always necessarily the same. So is there such a thing as a standard policy? First of all, standard policy. Let's talk a little bit about policy. Well, I'm going to show you something, and I just want... Most people get something in the mail every year when they get a renewal. Looks like this. This is called a deck page, or sometimes it's also known as a daily. Basically what this is a summary. This is not your policy, okay? Your policy is going to come in something like this, where you're going to have lots of stuff that you have to read. That's your policy. Most people don't even know that that's what they're supposed to have, because this is all the insurance company's going to send you, several sheets of paper. If you call me up and you say, Bob, I just had a loss, what's the story? I'm going to ask you to see your policy. And I'm going to ask to see this stuff, okay? Because that tells you what you're covered for and what you're not covered for, all right? Now, basically, most of your policies are written by what they call rating organizations. There's two major rating organizations. There's the ISO, better known as the Insurance Services Offices, and there's ACIS, the American Association of Insurance Services. ISO basically is the standard throughout the country for most policies. In other words, they prepare basically the standard wordings. ACIS is the second organization. They're basically located in the Midwest, and they do a lot of your farm owner stuff. Just for a little point of reference. Now, in addition to the forms that are promulgated by these two companies, and there are thousands of forms, insurance companies take these forms, usually the ISO form, and they change it. You've got companies like State Farm, which has all their own policies. So if you have a State Farm policy, you need to actually see their policy. Liberty Mutual is the same way. Allstate is the same way. Chubb is the same way. I can go through the whole list, but these are the three big ones. You got Nationwide, it's also a big one. Their policies are different. Now, GEICO follows more of the ISO forms, okay? The company I have, which is Selective, follows the ISO forms. Now, that being said, here's where it gets real complicated, okay? This is my policy. It is an ISO form. Edition date is 1991. ISO in 2000, same policy designation, different version. An ISO in their circular comes right out and tells you there are 40 different changes between the policy I have and the other version that they issued. Now, the insurance companies are allowed to use whatever versions they wish. So, in addition to having to know what policy you have, I have to know the version because they're different coverages. They're not the same. Now, you have designations, basically the ISO designations are followed by most companies. You have what they call a homeowner's 2 policy. Almost nobody has a homeowner's 2 policy. That's what they call the broad form cover policy, and nobody has it. And the reason why nobody has it is because the companies sell the HO3. Almost everyone here who owns a home, more likely than not, has an HO3. That is basically, quote, the standard in the industry. And if you have State Farm or if you have Liberty Mutual, it's a variation off of that, okay? In addition, you have HO4. Now, HO4 is your renter's cover. So if you live in an apartment, you have an HO4. Your next form is what they call an HO5. Your HO5 is a fairly new form. It's very expensive and most people don't have it. Basically, it provides broader coverage than the HO3. But for the money, unless you have a very, very high-end home, you're not really getting any value out of it, okay? You have an HO6. This is, how many people live in a condo? All right? If you live in a condo, if you have a condo, you have an HO6 or a variation of that form. That is a very specialized form designed to fit into the nature of the condo cover. And I'm not going to get into the condo cover. As a matter of fact, Barry is an expert in condos. And he can tell you all the pitfalls of that, because it gets to be really unusual. Last but not least, actually we have more, but I'm not going to get into all of them. These are the ones that you most likely will see. Next is what they call HO8. Now, an HO8 is probably going to become more and more in vogue. What it is, it's called a market value form. And when I go into the coverages, you'll see how the HO8 fits into the scheme of things. But it's designed for homes whose cost of reconstruction is so far in excess of its market value that it would almost be considered what they call a moral hazard to insure a home for its reconstruction costs when its market value is so dramatically less. This came into being in places like upstate New York and other Rust Bowl areas, where what you had was you had these big Victorian homes that you could buy for $35,000 any day of the week and would cost $1 million to rebuild. Okay? So that's what you have. Any questions so far? All right. Now, like I said, in addition to these forms, every one of these forms has a variation based on an addition date. Every homeowner's form has been updated from 1991 to the year 2000, and the insurance companies have the option of picking which ones they want. In addition, there are about 3,000 endorsements that are available to put on homeowners forms. Now, when you thought you got your arms around this whole thing, you have state rules that modify forms. Some states will tell you you cannot use a certain addition. Some states will tell you you cannot use certain exclusions. And it depends. New Jersey gives the insurance companies a pretty broad usage as far as additions go. Pennsylvania doesn't. In Pennsylvania, the 2000 form is the one that they insist on the companies using. So right away, if you own property in Pennsylvania and you own property here and you got a homeowners on them, and your company here has the 91 edition and the company in Pennsylvania has the 2000 edition, you got two different coverages. Okay? Now, let's dig a little deeper here. Let's talk about what's covered. First of all right, let me throw this out to you. What's your homeowners cover you for? Little feedback. No. Let's not talk about what could go wrong. What's your homeowners covering?
Replacement cost?
No. No. You're talking. No, land is not covered.
The structure.
What structures? Besides your house, what else? Your garage. What else is covered?
Roof.
Your roof, what else is it cover? Contents. All right. What else is it cover?
Liability.
Liability. Who said that? Ah, there he is. Yeah, the insurance guy. Yeah. That's it. You can't contribute anymore. All right. You got liability. What else does it cover?
Personal property.
Well, personal property, that's your contents. But it covers something else that most people don't even know about. Medical coverage. Who said that? Yeah. Your homeowner's policy has medical coverage on it. If somebody gets hurt on your property, it's a no-fault cover. It pays the medical bills.
If something's stolen from your car, isn't that covered by?
That's your contents. All right, but there's one other thing, one more thing that's covered. No, we talked about liability. You're talking about perils that are covered. I'm talking about things that are covered.
Jewelry?
We call it loss of use. Other people will call it additional living expense. It covers you for the time you cannot live in your house because of a loss. Okay? So it covers you for a lot of stuff. It covers you for the dwelling, outbuildings, personal property, loss of use, personal liability, medical payments. That's a lot of stuff to be covered under one policy.
Can you choose to take some of that out?
No.
That's it.
No, and I'll explain why. Because it falls under how much coverage you need. Yes, Bob?
Person, let's say, was saved,
Yeah.
but covered?
We'll talk about that. You're getting ahead of us, Bob. You're getting ahead of us. You're getting ahead of us. Okay? The dwelling. What's it covered for?
The building.
No, but what do you need? How much do you need? Here's where you get into the age-old argument of replacement cost versus market value. The insurance policy, your homeowner's policy, is predicated on replacement cost. If you're carrying what they call insurance to value, which is 80% of the replacement cost, the insurance policy gives you certain benefits. The main benefit that it gives you is if you have a loss, there is no depreciation taken against the loss. If you don't have it insured to within 80% of replacement cost, you will be subject to deductions for depreciation. That can be substantial. Okay?
So what's standing, so how do you know that?
How do you know? That's a magic question. There used to be, on the internet, there used to be calculators that you could go and calculate the replacement cost of your home. I did a search a couple of weeks ago, and every one of those calculators was taken off because people were suing the companies that put up the calculators because the numbers were inadequate. Your best bet, if you're insured directly, what they call a direct insurer, like State Farm or Liberty Mutual or Nationwide or any of these others, go to them and ask them how much you should be carrying. Have them do the calculations. And when they do, save that. And you should plan on updating that about every 2 years. Yes, Ed?
Aren't most of the carriers doing that for you automatically?
Not really.
No?
Some do and some don't, and some of them will just simply take the number you gave them 20 years ago and they update it by a couple of percentage points every year. That may or may not be accurate.
How do they know what you have?
You tell them.
In terms of things like artwork.
That's something else. Well, that's another, we're not talking about that. We're talking about dwelling, okay?
God forbid if you have a loss.
Yeah.
Big loss. Does it pay you to get a public adjuster?
I'll get into that when we start talking about Sandy, okay? Because I will talk a little bit about that. Remind me of that, okay? But this is the key. The key is, if you have an agent, go to your agent. They have calculators in the agency. They have formulas that they can plug in. You have to give them the information. You need to know the square footage of your home. You need to know when it was built. You need to know when you did the last maintenance and updating. Okay? These things you need to know. You need to tell them about things like fireplaces. Okay? In this area, most houses have central air conditioning. They have to know that. If you've done any upgrades, they need to know that. And then they can figure it out. Okay? Again, policy provisions. If you are insured within 80% of replacement costs, God forbid you have a loss, the loss to the building will be paid without deduction for depreciation. They will pay you what they call the actual cash value now, and when your repairs are done, they pay you the depreciation back. That's the way it works. Outbuildings. Now, outbuildings are basically your garage, your sheds, your pool. If those who can afford an outdoor pool, your cabanas, that's your outbuildings. No, deck is considered an extension of the building itself. Now, outbuildings are normally covered for 10% of whatever you have for your dwelling coverage. So if you have $500,000 on your house, you've got $50,000 on your outbuildings. Some policies will cover your outbuildings collectively, and some will cover them individually. Again, got to read the policy. I can't tell you. It would be a guess on my part. Okay? Personal property. Personal property is the contents in the house. That is normally covered for 50% of what you insure the house for. You can increase that by endorsement. You can buy replacement cost coverage for your contents.
What do you consider contents?
Anything that you can remove from the building without changing the value of the building.
All your furniture, not all your furniture?
All your furniture, carpeting over hardwood floors, okay? All your clothing, any
Other appliances, is that considered?
only those appliances that you can remove without changing the value of the building. Your washer and dryer, yes. Your washing machine, your dishwasher, if it's installed, no. Okay? Your refrigerator, sometimes yes, sometimes no. If you've got a Zero King, it's building. If you've got a regular poor person's refrigerator, it's contents. Okay? So it all depends.
You said 50% of your value?
It starts at 50% of the coverage on your building. If you've got $500,000 on your building, you've got $250,000 on your contents. Okay? Now, yes. Oh,
What type of things should you put in your policy for the special endorsement? I know for sure certain values will sure.
we're going to talk about that. Absolutely. Let me just, oh, here we go. Okay. Now, again, personal property is subject to replacement cost versus actual cash value because you can buy replacement cost coverage. Personal property is also subject to sublimits. Okay, let me read you some of the standard sublimits, and these will vary by company and by policy. Okay, $200 on money, bullion, or coins. So if you're used to carrying a lot of cash at home, you only got $200 worth of coverage for theft or for fire or for anything else. That's all you got, $200. You can increase that to $500 in some cases. Depends on your company, but that's all you got. Now, on securities, accounts, bills, deeds, or passports, $1,000. Jewelry, watches, or furs for theft, you got $1,000. Some companies kick it up to $5,000. That's it.
Per item or?
Total. Total. Per loss.
That's without $100,000 worth of jewelry.
Then you need to schedule it. You have to buy what they call a schedule. You're better off, if you have a substantial amount of jewelry, you're better off with a schedule anyway. Because your homeowner's policy does not give you complete coverage for your jewelry when it comes to theft. For instance, if a stone falls out of a ring, homeowner's policy is not going to pay you for it.
If it's scheduled, is it covered 100%?
No. Whoever said yes, no. No, you don't. No, you don't. You don't have 100% coverage. No, you don't. You got paid 100%, but you don't have 100% coverage. Because your ring might be worth more.
Yeah, but every
Or it might be worth less.
every year they raise the value of that ring from what I pay for it.
Yeah, and okay, yeah, it's close, but it's not 100%. Might be, but it's not. You can't say definitely. Okay, now, the reason why I say that is because when it comes to jewelry, especially jewelry, jeweler will tell you, I'm going to sell you a ring for $1,000, but you need to get it insured for $1,500. Why is he telling you that? Because he wants to sell you the ring. Okay? The insurance company is going to ask for the appraisal. The appraisal is going to describe exactly what that ring consists of. And they're going to go to a jeweler, and they're going to ask the jeweler, based on this description, what it's going to cost. And that's what they're going to pay you. They're going to pay you up to how much you insured it for. But it's either going to be the cost of replacing it or the amount that you covered it for. And that's it. And I'm going to tell you right now, I don't care what you have on your schedule, 50% of the items, guaranteed, are underinsured. Guaranteed. And that's just simply because that's the nature of jewelry. Okay? Silver, you get a similar problem. The major components of both silver and jewelry are subject to market changes. Okay? Now, for those of you who have guns and firearms, the average homeowner covers you for $2,000. That's it. Those people who are really into firearms will tell you $2,000 is not much when it comes to firearms. Okay? Silverware and goldware for theft, $2,500. Electronic data processing equipment, located at your home, $5,000. Now, for most people, that's adequate. There are some people, $5,000 barely touches what they have. So you have to be aware of sublimits. Now, with the sublimits, you can increase cover, either by endorsement or by a separate policy. Now, you were talking about artwork. Artwork absolutely should be separately appraised and insured. Because, God forbid you have a loss, you could have a real hard time proving A, the existence of your artwork, and B, the actual value of your artwork. Because artwork depends very, very much on condition as well as content. Yes?
We have pictures of just about everything we own, and that's kept in a safe.
Okay.
Is that helpful or not?
I'll put it to you this way. You want more pictures? I'll give you more pictures. You follow what I'm saying? The fact that you have photographs of what you have is not necessarily proof that you still have it, that you had it at the time of loss, or that it attests to the value of the items.
What about appraisals?
Appraisals are the best thing to have because they're an independent opinion, and that's what you should have. You should have your artwork appraised. You should have your jewelry appraised. You should have your coins appraised. You should have your stamps appraised.
How often should you have it appraised?
About every 2 years to 5 years.
I didn't hear you use the word vandalism. That's covered?
Vandalism, yes. Vandalism and malicious mischief are covered. Terrorism, on the other hand, may or may not be covered.
Is vandalism covered under the same rules?
Yep. Yes, Mike? Well, that's another subject. I don't want to get into that. That's a whole other subject. I could spend a half a day talking about umbrella policies and never scratch the surface. I know.
Are they worth it?
Umbrella policies? Absolutely. Okay? The short answer is, if you have any assets, you're not going to have enough coverage under your auto policy, under your liability policy to protect you. You should have an umbrella, at least $1 million. It's cheap enough. It's about $200 per million. Okay? Now, high value property. Now let's talk a little bit about loss of use, or as they call additional living expense. Additional living expense is valued at 30% of the value of the building. So if your building is $500,000, 30% is $150,000. That's what you have for additional living expense. Now, additional living expense is exactly what it's for. Expenses above and beyond your normal cost of living. So, if you have to live in a hotel, they're going to pick up the hotel bill. If you have to eat out, they're going to pick up the food less what your normal cost of eating is. Now, there are two limitations on additional living expense. One is the duration of the time that it takes to repair the structure so that you can reoccupy it. And the second is most homeowners' policies now are limited to additional living expense for 1 year from the date of loss. And the reason for that is because of the hurricanes, where people were unable to move back in for 18 months, 2 years. Okay? Your personal liability coverage is set at $300,000, and your medical payments is set at $1,000. Both can be increased subject to endorsements. Okay? Any questions? Dave, I know you had a question.
Yeah, I got three questions here.
You got three.
Okay, first of all, is the effect of Sandy on...
We're not going to talk about Sandy right now. We're going to talk about Sandy after.
Okay, because all insurance companies are going to be
I'm
paying.
going to talk about Sandy after.
Okay. Solar panels, how does that come in, and do you think it's worth it to have solar panels?
Whether I think it's worth it or not is just my opinion, and I wouldn't give you a nickel for my opinion on that stuff. But I wrote policies for companies that build solar panels to ensure solar arrays, which are much bigger than what you'll ever see on a home. Bottom line is, it would be considered part of the building, okay? Because it's permanently installed. Now, whether it's worth it or not,
I put solar panels on. I called my existing
Yeah.
insurance company prior to putting them on.
Yeah.
It was Allstate. They said, as soon as you do it, we'll drop your policy.
okay. There's
I
your
called
answer.
Liberty Mutual,
Yeah,
and they said, as soon as you put them on, you're covered. For the day you put them on, we consider it part of your house.
right,
And their premium was like $200 less than what I was paying.
okay.
Okay, the third thing is, you keep hearing ads on television saying if you have loss, don't go to your insurance company, go to one of these other adjustment companies. and all
I'll
that.
talk
Tell us what you think about
I
that.
will talk about that when we get, just keep that question. Somebody asked that question also about public adjusters. Keep that question when we talk a little bit about Sandy.
If you're if you sense that you're underinsured,
Yes?
to whom do you go for an assessment of what you have and what you should be doing?
Okay, I'll repeat myself again. If you're with a direct insurer, go to your insurance company and ask them to tell you what your house is worth. If you're insured through an agent, go to your agent and say, I'd like you to recalculate the value of my house for insurance purposes. I think I need to increase it.
What about content? Same thing, or?
Contents is in the mind of the beholder. It's not worth it to do an appraisal. Once you increase your dwelling coverage, your contents coverage goes up. If you get replacement cost, you're going to end up with about 75% of the building cost for replacement cost on your contents. Right? Does everybody follow that? If you want to get replacement cost coverage on your contents, it's still going to be keyed to what your dwelling values are. Usually 75 or 80% of whatever the dwelling value is how much they'll cover your contents for. Some companies will go up to 90% of the dwelling cover. But just remember, you can buy as much coverage as you want, but you'll pay for it. Okay? Now, let's talk about how the policy is priced. Each version, remember we talked about HO2, 3, 4, they're all different prices. Each edition is a different price depending on what the coverages are. Now, they're not going to be that much of a variation on editions, but they do vary. You buy endorsements, you're going to pay. The best endorsement around that you can buy is what they call a code endorsement. In other words, your house is going to be covered for the additional cost to bring it up to code for electric, for plumbing, and for any of the other requirements that your town may have. Usually they charge $1 for it. $1 could be the difference between having a 100 amp service that needs to be upgraded to 200 amp service, which is about a $1,200 bill. Okay? So for $1, you're going to get $1,200 worth of coverage. The other coverage, which is well worth it, is also costs $1. That's for backup from sewers and drains, which you can buy. Okay?
So those two things are not normally in the policy?
No, they're not. They're excluded, specifically. Bringing your house up to code because of building code changes, and you have, for instance, the most common is your electrical. If you have major electrical damage, the building inspector is going to come in and say you got to put the building up to code. So if your code is 200 amp for where you had a 100 amp service, you got to pay the difference. You got to put in a whole new circuit board. You know, a whole new what do you call it? Breaker board.
What's the other upgrade?
The other upgrade is backup through sewers and drains.
say it's $1, how come I was charged 75?
Well, they saw you coming.
Okay, and I got to call them up, even though they cut my policy. I was
It-
robbed.
it-
Save your personal thing, you got so much.
The bottom line is, it varies, okay? Yeah, we got a lot to go through.
How about if you have a septic?
Now, losses. Let's talk a little bit about losses.
I was gonna say, how about if you have a septic? Is that including backup?
Anything which comes from below the surface of the ground is excluded.
I mean, if you buy a policy for $1, does that cover your septic system?
You're not buying a policy, you're buying an endorsement. It'll cover you for any backup through sewers and drains. Now, some companies may charge you more than $1. I say $1 because it's a small amount compared to the amount of damage. The average company charges you about, $1, $2, $5. If you got a company that's charging you $75, I don't know. That seems like a lot.
Does that cover septic? Septic.
You got to talk to your every policy is different.
What's the average cost of city bill?
It's a small amount. I mean, I'll take a look at mine and I'll tell you after. But it's a small amount. It's not a lot of money for the coverage you get.
If you have a loss and it's a little bit over whatever that means over your deductible, is it worthwhile to put in the claim, or is it going to force you more and more?
Excellent question. Segues right into what we're going to talk about. Okay. Basically, to rephrase the question is, am I going to get charged if I have a loss? The short answer is no. The practical answer is, you bet your ass. Okay? Now let me explain basically how it works. Let's talk about rates. Every insurance policy is based on a rating structure. Where's Alan? Is Alan still here? Alan. Alan's an actuary. One of Alan's jobs is to take information generated by his company and determine whether or not the prevailing rate structure is adequate to cover potential losses for next year. If they are, that's good. If they're not, then the company has to make a decision as to whether or not it wants to go to the insurance department and ask for a rate increase. That's the way rates are calculated. So, let's talk a little bit more. Rates come in 3 different flavors: standard rate, a preferred rate, and a non-preferred rate. Now, this will vary. This will vary all over the place depending on the company. But this is basically what they talk about. Your standard rate is what the company has gone to the insurance department with and has been approved. That's your standard rate. What rate do you think your insurance company is going to quote you if they want to get your business? Preferred rate. Why the preferred rate? Because the preferred rate is so much less than the standard rate. Insurance companies are allowed to do what's called deviations. They can do deviations based on all kinds of information. They get rate discounts. Insurance score, which is better known as a credit score. Such things as premises alarms or fire protection. Multiple policy discounts. Okay? These are all the things that you can get credits for. In addition, they can deviate. And it all depends. Some states will allow deviations as high as 25% off of the standard rate. So let's say you have $1,000 as your standard rate. and you take off 10% for the first 3 and 25% for the deviation, you're going to pay $650 for your coverage. What happens if you have a loss? Well, there are criteria that the underwriters have for what is a standard business, what's a preferred business, and what's a non-preferred business. And some people in this room have experienced what happens when you get bounced from the preferred to the non-preferred. And it doesn't take much. 2 losses in 24 months for most companies will put you from the preferred to the non-preferred. How does that affect your rate? Well, first of all, you go back to the standard rate. So from $650, you're back up to $1,000. Now, from there, they can deviate upwards. So let's say they deviate upwards by 25%. Well, you were paying $650, now you're paying $1,250. You're paying almost double. And that's how it works. So if you have a loss, do you save money? Do you lose money? Did you get that roof for free? As those contractors came around and tried to convince you. I'm going to tell you, in the long run, you're going to pay for that roof many times over. Especially when the plain fact of the matter is you really didn't need it. Okay? Now, I want to talk about a couple of other things here. And then we'll get into Sandy. We'll talk about public adjusters. 3 little words that can cause tremendous, unexpected complications. First of all, see that word? Okay. How many people have had a broken pipe in their house? How many people had their basement fill up with water because of a broken pipe? How many people called up their insurance agent and said, I have a flood. Is it covered? And you know what the agent's going to tell you? I'll tell you exactly what the agent is going to tell you. Read your policy. Floods are not covered. Goodbye. And that's what it says. Right there in red. Flood is not covered.
Can you quote something else?
When you say flood, the insurance company is going to look at flood. They're going to talk about the definition of flood. Okay? Which is the inundation of naturally dry land. That's water from the outside, flood.
And a wet basement.
What you meant is you had water damage. When you have a broken pipe, or if you have a washing machine that overflows, or if you have a toilet that overflows, or if you have anything like that, you call up your agent. What you say is, I have water damage. Okay? If you say, I have flood, you're going to get that. You're not covered. Okay? Now, how many people here have summer properties? All right. It used to be pretty prevalent that people who lived away from the shore had summer properties up in the Poconos or down at the shore. Somebody breaks into your summer property, steals everything, cleans you out, takes your televisions, takes all your plumbing out, and that happens. Believe me, that happens. Insurance company is going to ask you, was there anybody living at your place at the time it occurred? Most people will say, no, it was vacant. Okay? Now, this is what vacant means to the insurance company. In other words, nobody was living there and nobody could live there because there's nothing there. That's not what you meant. What you meant was it's unoccupied. Vacant voids your policy for certain losses. Unoccupancy doesn't. All right? My favorite, arson. I had an arson. You had a what? I had an arson. You know what that means? That means that your insurance company is now obligated to do a seriously in-depth investigation because it's a crime. So they have to contact the state police, and you're going to get the arson investigators in there because you had a fire. Unknown or suspicious origin. You didn't have an arson, you don't know. These are the things that you have to be aware of. These three little words, flood, vacant, and arson, will cost you dearly in time and aggravation. Now, or we can always say I had a fire, yeah. They're going to say, well, what caused the fire? Yeah. You say Jewish lightning, and they'll not only have the investigators there, they'll have called you a rabbi. Now, I said I would talk a little bit about Sandy, so let me talk a little bit about Sandy. Sandy was the hurricane that never happened. Okay? It technically was not a hurricane. That's first of all. And let me explain something very quickly. Most policies have what they call a hurricane deductible. It's pretty severe. But if you look at your policy, you're going to see that that deductible is keyed to zip codes. Our zip code is not in there. Our zip codes all in this area are not in there. So technically, we don't have hurricane deductibles. Okay? Now, to put Sandy into some perspective, Swiss Re, which is a company I used to work for, a company Alan used to work for, has just published some statistics on catastrophes. There have been $11 billion catastrophes for the year 2012. Gross amount of loss is about $140 billion. Sandy, right now, is the second largest or second costliest natural catastrophe in U.S. history, only outpaced by Katrina. Katrina is about $82 billion right now. Sandy is about $50 billion, and it's still counting. From past experience, it takes about a year and a half to 2 years before the numbers really harden up so that you can tell what these catastrophes are going to cost. Talk a little bit about public adjusters. Is everybody familiar with the term public adjuster? Is there anybody who's not familiar with the term public adjuster? Byron, you understand public adjuster? Yeah, talk.
What is it?
Public adjuster basically is a person who represents your interests when you have a loss. I will tell you that for the majority of losses that people have, it's a waste of money, and I'll explain why. Most people have small losses. No, up to like $15,000. That's considered a small loss. $20,000 is considered a small loss. Most public adjusters that I have seen in this area will charge you anywhere from 25 to 30% for that.
How much?
25 to 30%. There are several public adjusters who are right now in front of either attorney generals or insurance commissions because of the rates that they've been charging and the lack of service that they're producing. Standard public adjuster, the real professionals, first of all, will tell you for a loss under $20,000, it's not worth their time because they're going to get between 8 and 15% at the most. At the most. Public adjusters, if you have a very complex loss, and most homeowners' losses are not complex, if you have, God forbid, you have injuries as a result of a loss, you need somebody to help you do the work, you hire a public adjuster. If you have a very, like I said, very complicated claim, usually commercial claims, you might want to consider a public adjuster. Most of the time, not really. I mean, you're going to hear the story, oh, my public adjuster got me another $5,000. Well, how did you know how much it was going to cost you to begin with? You don't. The public adjuster is going to tell you, oh, you got $10,000 worth of loss, I can get you 15. Why? Because he wants to make money. Okay? There are reputable public adjusters out there, and there are disreputable public adjusters.
Anybody in this group an adjuster?
Not that I know of. But I will tell you, I have friends who are public adjusters, and I know, what they, what they do.
How about for a major loss?
If you have a major loss and you are incapable of doing an inventory, you're incapable of getting an estimate to rebuild your house, then you hire a public adjuster, and he's going to take somewhere between 8 and 15%. And let me clue you in, he's not going to make money for you. Public adjusters will tell you about all kinds of stuff that they're going to get beyond what the insurance company would be willing to pay you. If you've got a decent company, the adjuster is going to tell you what you're covered for. They have to. If they don't, they're in violation of the unfair claims practices statutes in just about every state in the United States. Yes, Myron?
Living over 55, and we had issues with the roofs in the community, now they're replaced. But at the time that the people were having roof damage, including me, the adjuster came out from Liberty.
Yeah.
And he said, give me a number. And I said, we can fix it for that number and it'll be covered by insurance. I said, go ahead. So,
Exactly.
there was
Yeah.
a contract.
Exactly.
I figured, whatever's extra, it has to be covered in the deal, so I don't do it.
Different subject related to Sandy, actually. What is the story with assessment, condo, insurance for assessment? Get it?
Can you repeat the question?
Insurance for
No,
assessment.
I want him to repeat the question so that we just
In insurance, in other words, for the condo assessment, because there wasn't enough insurance coverage and you've been assessed for it, can you buy that coverage? My answer is a qualified probably. And I say a qualified probably because it may be more expensive than you're willing to pay. You can buy almost any kind of endorsement to your policy. You may not get it through a standard company. You may have to go to what they call a non-standard or an excess and surplus lines company. But you can get coverage for damned almost anything. But is it really worth what you're going to pay? I mean, a $5,000 assessment that you may pay once in a lifetime, is it worth it to pay $1,500 a year forever? I don't know. Yes?
The coverages that you mentioned, Bob, like for code.
Yes.
Until you mentioned it, I never would even have known that.
Okay.
Is that something that's in your policy that would say, for another $1 you get code,
No.
for $1 you get sewage?
No.
How would you know what question to even ask? I would never even know that.
Well, you want to know? Read your exclusions. Whatever the policy doesn't pay you, it tells you it's not going to pay you for, you call up your agent. If you really think you're going to have that kind of loss, you call up your agent and you say, hey, can I get coverage for that? And how much will it cost me? And usually it's a very small amount for these coverages. I say $1. It may be, an exaggeration on the low side, but it surely isn't hundreds of dollars. Mold is another thing which is highly limited on your homeowner's policy. Well, you can increase those limits.
Yeah.
Dave?
A couple of questions.
Sure.
The first one deals with Sandy. I wasn't concerned about Sandy per se.
Okay.
I was concerned about what rate increases are we likely to face because of what insurance company's going to be paid. And second of all, I used to have an alarm. I don't have it anymore. How much is that likely to have my premium when I tell the insurance company?
That could increase your premium by 10, 15%, maybe a little bit more.
Just the fire, the alarm.
If you really want to know how much it is, go to your deck page. You'll see where they actually tell you what your discount is for your alarm system.
I thought it was all bundled together.
No. It's all broken down. All your endorsements should be broken down into what you're paying for. And if they're not, you call up your insurance company and you ask them for a breakdown. Okay? And it's in there.
So you're talking about burglary or fire? Alarm?
Alarm system. Burglar alarm system, fire alarm system.
Some have fire going in, some don't.
Yeah. Usually they make very little distinction between them.
Burglar alarm system.
Now, you would also raise the question about flood when you talk about Sandy. That, I can tell you, is a good, I mean, there are seminars that are running days about that. There are hundreds and hundreds of lawsuits over that. The bottom line is, you're not covered for flood of any type based on the definition of flood on your homeowner's policy. So if you got water coming in from a stream that gets into your house, not covered. I will tell you about the flood policy. The flood policy is not the greatest thing in the world either. If you have damage from a flood and it only damages the first floor, which they consider the basement, you're not going to get paid for any contents at all, and only for your mechanicals and any structural building, any structural damage, yeah.
Bob, as a result of the non-hurricane, we had no electricity for 3 days.
Yeah.
And we lost a freezer full of food. A, is it covered, and B, is it worth filing a claim?
Okay. Let me put that into a little perspective. The standard homeowner's policy's got a $500 deductible. How much food did you actually lose? Okay? If you lost $700 worth of food, no, it's not worth it. If you lost $10,000 worth of food, yeah. Okay, now.
The caviar went
Now, wait a minute.
It's kosher food.
Oh, millions. All right, now, when you talk about when you talk about the loss of utility service to your building, to your home, the policy basically covers you for what they call power interruption, but only if the power interruption is as a result of damage on your premise. If the telephone pole 3 blocks down gets hit by a car and knocks your power out, not covered. You can buy endorsements, because like I said, you can buy endorsements for almost anything. But you have to measure whether the cost of the endorsement's worth the actual loss you're going to sustain. Okay? This is the hard part about insurance, is that it's like beauty. It's in the mind of the beholder. If you think you have that exposure, then you buy that coverage. Eric?
Yeah. Most agents don't go over this in such detail as you know right now. Is that correct?
Yeah,
Sign a new policy.
I will give you my personal opinion, and this is strictly my personal opinion. Most agents are salesmen. They're not going to tell you things that are going to kill the deal. Most of them, not most of them, a good percentage of them have no idea what these policies cover.
Really?
Yeah.
Yeah, you've been doing it quite a while.
40, going on 44 years.
I just signed a new policy.
I'm not an agent. I don't sell it, Eric.
You don't sell it? You don't
No,
sell it?
no. I get enough headaches. I don't have to deal with the general public.
You're a teacher.
Basically, I tell you, I'm a subject matter expert.
Come CBC.
Yeah, well, I hold 4 different designations in the insurance industry. I'm a CPCU, I have an associate in reinsurance, I have associate in claims, and I have a general insurance certificate.
What about the BS?
I also have the Randy Accorsi BS degree, too.
You started out telling us of your expertise, and you're ending off by demonstrating it. I thank you very much.
Well, I thank you for your attention.
And as you know, because you've handed these out so many times, our certificate of appreciation, we really do appreciate it.
Hang it on the wall.
If there are more questions, are you available
Yeah,
after the meeting?
if anybody has any more questions, I'll be more than happy to talk to you.
You want to pick out?
Wait a minute. Who's our newest member? Eric.
He's not a member yet.
Didn't he pay his money?
No, only breakfast.
Oh, okay.
The winning share is $48.
No. Reach in there and grab a ticket.
Pick my ticket.
Just reach in there and grab a ticket.
$48.
Just one ticket?
Just one.
All
right, let's see the ticket. All right.
How come it's his ticket?
Is it blue?
It's blue.
Okay.
It's also got a 325 to start with. Then it's got a 5.
You're doing good.
A 0.
No, that's not so good.
A 2. Over there.
Congratulations. Thank you again, Bob. As usual, I got 3 quick items. Item number 1. We have here a packet of South Jersey Men's Club application forms and brochures. If you have friends, relatives, or people that you really dislike a lot, give them one of these forms and have them join us. Okay? They'll like you a lot more. Number 2, in our website, sjmclub.org website, Steve Horvitz has been putting together a list of links to Israel-oriented websites, like Haaretz and the one I like, which is the Daily Alert. There are several websites that we all go to learn about Israel. If you don't have a website that you like, go to our website and link to one of these websites. If you have a website that you like, let Steve Horvitz know, and he'll add it to our list of links. But there are a few that we all go to, and I'm finding that going just to our website and linking from there is a very convenient way of getting information about Israel. And number 3, there is an investment club meeting right after this meeting, even though Art Cork isn't here. His dad Sam is here, and he's got a few items for the investment club. So please hang around for that meeting. With that, we'll see you next month. Have a great month, everybody. Don't go off the cliff.
Happy New Year.